Personal finance practice problem using Excel. Debt payments to income ratio. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. We're going to populate that into the blue area on the right-hand side. We're going to be calculating the debt payments to income ratio. Information on the left, we have the monthly gross income, the income tax withheld, Social Security tax withholdings. So in essence, in other words, we're assuming we are a W-2 employee. We have the gross wages, what we would actually earn on a monthly basis, which we would find on the pay stub that would need to be provided to us of the $3,200, although that would not be the amount that hits our bank account, because we would have withholdings, which are going to include at least the federal withholdings if you're in the United States, which would include the federal income tax, Social Security, and Medicare, which would be taken out to get to the net check. You also may have state taxes, and you also might have other kind of withholdings, such as retirement benefits or the health insurance or something like that that's being pulled out. We're going to say that the IRA, we're putting money into an IRA of the 290. Now note that the IRA is not the same as a 401k plan per se. 401k plan being a benefit, for example, or another kind of retirement plan could be similar in that it comes directly out of our paycheck as withholding, but we're going to assume the IRA is a similar fashion. We're putting money into, in other words, a retirement plan, and we want to commit to that. It's going to be automatically coming out and going into the retirement plan. Then we have the monthly credit card payments, which we're saying are credit card 1 and 2, and then the monthly auto loan payments. These are our debts that we're going to be dealing with. Now, first, we're going to take a look at what our income is, which we might call basically the net pay. Now, this is the first area that's a little bit confusing when you think about these kinds of ratios, because these ratios are a little bit different. They're less standardized than you might see in a corporate type of setting if you were to look at the financial statements of a corporation. Same concepts, but a little bit less standardized, and therefore, I mean, we don't have the same kind of regulations you might have on a corporate side, or as much of the same concepts going across that are kind of standardized concepts. So in other words, if you're doing this calculation, say for the bank or something like that, then you got to clarify exactly how they want to calculate something so that you can represent the numbers as the way they want it. If you're doing it for yourself, then you want to use whatever calculation that you think is best for your particular purposes. And if you're comparing to other people and trying to match what they're doing, you got to clarify exactly kind of how exactly are you calculating this, because you might not have the same exact, you want to make sure that you're using the same standards and they're not completely uniform on the personal finance side as much as they are possibly on the corporate finance side. So for example, if we're looking at the income, you could say, should I take the gross income, which I would be pulling from my pay stub? In this case, we have the monthly gross income, which we made nice and convenient here because we're assuming we got paid per month. If you get paid in some other format like weekly or something like that, what you would want to do is annualize your income and then divide it by 12 to get the monthly income. Or if you get paid bi-weekly, you would annualize it and then divide by 12. So typically, if you're getting paid a salary, you take kind of the annual salary divided by 12. And then we've got the income taxes withheld. So we could take the gross pay and use that as our number when we think about our debt payments to income ratio. But we could get a little bit more restrictive, and we could say, well, why don't I take my net pay after the things that I've kind of committed to that are coming out basically automatically, which of course include the payroll taxes, because those are coming out no matter what. You might not even you might simply be recording income on your personal income statement, not gross, but net after what actually hits the bank account if you're using a cash basis kind of system. So and that's what we're going to do here. We're going to take out the withholdings, and then we're also going to take out the IRA, which we're going to assume is a standard kind of payment that we're going to be making to get to our net. We're going to call it income, but it's going to be basically the net pay instead of our gross pay. So that's the first thing you got to kind of clarify if you're trying to communicate this to somebody else. You're talking gross pay, or are you talking net pay? Now, note someone also might call it net income, which is a confusing term because net income might be referred to try to say what the net pay is, meaning after the withholdings and whatnot. but not including other expenses like food and gas and so on. But usually on a corporate side, if you hear someone say net income, they mean the bottom line of the income statement after all expenses. So just be careful of the terminology you might use for the top line of, say, your income statement, your income, versus the bottom line, which is usually called net income after all expenses. Okay, so we're going to be taking the monthly gross income, which is going to be equal to the 3,200, and then I'm going to take out the withholdings to get to our basically pay after the withholdings. So what would actually hit our bank account. I'm going to use these as a negative, so I want these to show up as a negative. So instead of equals, I'm going to say negative of the 890. And then this is going to be equal to the Social Security. I want this to be reflected as a negative, so I'm going to say negative of the 450. And even though this is not coming directly out of my pay, I'm going to say this is a direct transfer, something I'm committed to. So I'm going to treat it in a similar fashion as if it's going to be taken out of my pay. I'm going to say this is equal to the monthly contributions, negative of that 290. Going to underline that. And I'm going to call this my net cash flow. And so basically, let's call it income, and we'll say net pay instead of the gross pay. And so I'm going to sum this up, which will subtract out 3,200 minus the 890 minus the 450 minus the 290. So this is going to equal the SUM, shift 9, up arrow. I'm summing it up, but those negative numbers allow me to do the subtraction problem. We got the 1,570. Now, again, that's not my net income, but instead of using gross income, I'm taking out basically, in essence, the withholdings, which would be the net pay if that amount was coming out of my pay, but I'm also just going to assume that's a monthly payment. So I'm going to say that's kind of the top line of kind of my income statement line, not after all the other expenses that would be involved. And then we're going to be calculating what our monthly debt payments are, which is straightforward. We're just going to take the monthly payments, which are the credit card payments. So we got credit card 1 over here equals the 215. We got credit card 2. Now these are how much we're paying monthly, and you might be asking, well, how do I know? I mean, I might pay a different amount monthly, so you're going to have to kind of estimate how much you're paying off if you have a balance on the credit card. How much basically are you planning to be paying off on the monthly balance? And again, you could be thinking about this, well, am I talking the minimum balance that I have to pay off? Maybe if you're trying to figure out whether or not, you can cover kind of the minimum balance, or you might try to decide what actual balance you're going to be, paying on a monthly basis to basically pay off the card at some future point. And then the monthly auto loan payments, we're going to say that, of course, will be a straightforward payment, including both interest and principal, which would be the 445. Going to underline that, font group and underline, and this is going to be then the monthly debt payments. And we'll sum that up, equals the SUM, shift 9. And then we'll pick up, that's going to be the 866. So then we could just compare the two out. So now we're going to be saying that we have the monthly debt payments. This is where the ratio takes place of the 866 that we're going to pay on a monthly basis. And then we've got the net. We're comparing that to our net pay instead of our gross pay. Again, you could try to compare it to your gross pay. It depends on who you're talking to, or what kind of calculation you're going to be. Obviously, this is a more restrictive calculation because we're looking at the pay after, the withholdings and taxes. So the numerator here, the denominator is going to be a smaller number here. So then we're going to be taking, this is equal to the 1570, and then that's going to be our debt payments to income ratio, which will be equal to the division problem of the debt payments, 866 divided by the 1570. Let's make that a percent number group, percentify it, add a couple decimals. So there we have it. And then we're going to the font group, underline. So there we have that. And so normally it's recommended to have this under the 20%, should generally be around 20% or lower is the general recommendation. So notice, obviously we're over on that amount, so we want to basically, make some changes if possible. Now remember, as you look at this payment, there's a couple things to kind of consider. One, we used the net pay, which I guess you can call a more conservative type of number, meaning it's lower than it would have been if we used the gross pay. So if you use the gross pay, in other words, you'd be looking a little bit better here. We'd be at the 27.06%, but we're going to say the net pay, and that's at the 55.16. And then you also have some questions with regards to the credit card payments. Are we talking minimum payments in order for us to cover the minimum balance payments that are due, or are we talking basically payments that you've committed to pay off the balance at some future point in time, or a payment that you believe is going to be more reasonable to kind of pay off the balance to avoid interest payments into the future? So the discussion of what exactly are going to be your credit card payments, you have a bit of flexibility to think about what your monthly payments are going to be there. You could run some different kind of scenarios in terms of what your minimum payments might be with regards to the credit cards, which again, of course, can impact the debt payment ratio calculation down here. So like I say, if you're doing this for a bank or something like that wants a similar type of calculation, you would need to clarify these. If you're comparing them to somebody else, you'd want to make sure that you understand what exactly they're taking into consideration with their calculations with regards to the gross pay and the net pay on the pay stub, and with regards to the calculations for areas where you might have some flexibility with regards to the minimum payment or the monthly payments to pay off the credit card debt and any other debt where you have some kind of flexibility with it. If you're running this for your own purposes, then you might test it out and run a couple different scenarios with some of these different factors to get to use the number in the calculation that you think would fit bet with your own kind of judgment calls on what you want to do in terms of the financing. So this, of course, means that we have the monthly debt payments of the 866 are 55.16% of the net pay calculation, which would be a high percentage.